right, so welcome to chapter 8, which focuses on receivables, both how to report it and how to analyze it. So we're going to just sort of start our journey today simply with learning objective 1 about how companies recognize receivables. Okay, that's our focus today. So there's a lot of different receivables on the books. You'd be kind of surprised. The big ones that we are going to focus on is accounts receivable, which is basically the customers owe us money because we sold them something and we allowed them to pay us later. So that's on account, right? We put it on account. So that account is receivable because we're waiting to receive that money. Sometimes customers that we're waiting to receive money from, and these, when I say customers, it's business customers, business to business. You and I can't go in there and do this type of stuff. But businesses with other businesses have these arrangements. Sometimes businesses need more than 30 days to pay up. Okay. And so what some companies would do and say, fine, we'll allow you to pay us in 60 or 90 or 120 days rather than 30 days, but we're going to charge you interest. Okay. And so the accounts receivable turn into a notes receivable. Remember, the word note in accounting is loan. And so basically speaking, this is how notes receivable are basically born. They're almost always accounts receivable that need a longer period of time to pay than the 30 days. And so the business agrees to extend that for a longer period of time in exchange for interest. Both parties sign a written promissory note. And there you go. This is what the chapter is focused on, both the accounts receivable and the notes receivable. This is the focus of this particular chapter. Although there are a lot of other receivables, they introduce you to a few of them here. If you study accounting in more detail, as you keep going, you'll see accounts like interest receivable and income taxes receivable, which is refundable. There's a lot of loans and advances that go on to employees of corporations, and so those have to be paid back, so they become receivables. So you'll see a lot of different receivables that we consider, we call a non-trade receivable, because it has nothing to do with us selling a good or a service, which is why notes receivables are also called trade receivables, because we're trading a good or a service in exchange for that payment at a later date. Okay, so just some interesting things there. Receivables are common across the board. Some companies, like in the automotive industry, have a substantial amount of their assets in receivables, and it makes a lot of sense. So this is GE as well. This makes a lot of sense because of the type of business that they're in. Okay, so let me stick with the automotive group as an example here. So you have Ford Motor Company, which is a manufacturer of cars and trucks and SUVs, right? So they build all these cars and then they sell those to regional distributors, and so the regional distributors are not paying cash for those cars. They might put down some cash on payment of that, but for the most part, that's where a lot of these receivables happen. Okay. What happens to those distributors? Those distributors sell those cars to the dealers. You and I go into a dealer, they get their cars usually from regional distributors of their brand. And they didn't pay cash for those cars either. For the most part, they owe that money. So there's actually quite a long chain of receivables in the automotive industry, from the retailer waiting to pay the distributor, who's waiting to pay the manufacturer, and all of those would be receivables to in that chain. So so that's basically how those types of work. But again, these are amounts due from companies usually, and they will be turned into cash when they will be received. Right? So receivables turn into cash. Again, anytime a business sells or works on account, right? So these ideas are, I'm going to sell you this product and on account, which means I'll receive payment later. Or for a service organization, I will do this work for you now, and I will receive payment for my work later, right? All of that. So on account, very important little phrase that I've been emphasizing since back in the day, right? For a seller, an accounts receivable is kind of has some interesting dynamics, right? Because sellers who have that receivable might offer a discount to collect the cash more quickly. And so are they really going to receive everything they're waiting to receive if they've promised a discount if they pay early? So that's going to affect receivables as well. And also what happens is buyers return goods. And so if they bought something on account and that gets returns, then that's going to reduce the receivables as well. So it's actually quite a dynamic account. In the corporate world, there's a lot of stuff going on in accounts receivable. So you all kind of know how this works from way back in the day when we did retail and merchandising. We had one company that sells merchandise on account to another company, and they give them payment terms, 210 net 30, right? So if we were actually the accountant for Jordash, who sold the merchandise to Polo, our entry would be a debit to accounts receivable for the sale and a credit to service revenue, right, to show that. So this is how, again, it would start off, right? Of course, we would also need to do cost of goods sold and inventory. That's not, we're going to focus on the receivable piece here. Then they get a return. So what happens to that return is going to affect accounts receivable again, right? Because that sales returns and allowance is going to reduce our net sales. And then of course the credit is going to go to receivables because we're not going to be receiving that because that's been returned, right? So it's again a dynamic account in this regard. And of course, when they receive payment for the balance that has been due, that's going to affect receivables. Now, in this case, the payment came early. So this $900 of receivables is only $882 worth of cash because they provided a discount of $18 or 2% of the sale if paid within 10 days. And so, even though this is $900 of receivables, it actually only turned into $882 of cash. So this is going to tell you this is sort of a little bit of an insight on receivable. Even though it's an asset account and it has a particular value, clearly $882 is a little bit short of the $900. So is it really the value of receivables is the question we're going to deal with next class. Of course, retailers sometimes have their own credit cards. Of course, now they basically outsource that to banks that specialize in issuing retail cards. But some companies had their own credit cards, which means they're keeping track of all that. So JCPenney, Sears, they all started this way. So if you use your JCPenney credit card to purchase clothing for $300, of course, that sale would show up as part of an accounts receivable debit and a sales revenue credit. However, every time you use a retail card, it comes with usually a very high interest rate. And so assume JCPenney charges 18% interest, that's for the year. So each month is 1.5% interest. So that would mean that $300 would also have an interest charge of $4.50. Okay, so we also need to show those interest charges in the accounts receivable for those companies that have their own credit cards. Okay, because literally they are waiting to receive this because of interest on the purchase. Interest, as you probably know, anytime a company earns interest, it's revenue. It's revenue. If you earn interest, you made a loan and you earned interest on that loan, you have to show that as your revenue, an additional revenue. So interest revenue is where that would show up. So this is interesting because again, this for companies that do have their own cards, it also affects receivables in another way. Okay. This is, I think you've been subject to enough fraud in the previous chapter. I will go ahead and release you from that. But here you had a person who was an accounts receivable clerk for a nonprofit foundation who basically got away with $1.5 million of their money because this person was able to do too much, right? She was able to, in this case, able to get away with lots of different things. She was able to handle cash, record cash, make deposits, prepare bank reconciliations, and do receivables. So there was just too much going on, which for a lot of nonprofits that are not so large is common. That one person or will have a lot of this type of control. But again, as the company or the nonprofit gets larger and larger, they have to put these controls in to stop the fraud. How was she able to get away with that? Well, she had her boss who really wasn't very good at his job either. And so basically speaking, he was the control. He was the independent verification, and he just didn't do his job. Didn't notice anything. Okay, and so he was terminated as well. So this is again, fraud is a major issue in all categories. And so basically, this is how we introduce you to receivables. Recognizing receivables is nothing new. You've seen all these before. But receivables is a very active account. So on May the 1st, Wilton sold merchandise on account to Bates for $50,000. Notice the terms, 315, net 45. A few days later, they returned merchandise. And then within 10 days, they paid the balance due. So we're supposed to prepare the journal entries here for Wilton, and we're going to ignore cost of goods sold, which we normally would not do, but your book wants you to. So the first thing we do in May is recognize that we sold that merchandise on account to Bates. So we set up an accounts receivable for Bates on our books and show that we sold that. We have to record the fact that Bates returned merchandise. $2,000 worth of merchandise was returned. And again, we have to take that out of the receivables for Bates's account. Okay. And then they paid us, but within that 15-day period. So they took 3% discount on what was left over. So if you start with $50,000 and you return $2,000, you owe $48,000. All $48,000 was accounted for because they gave us $46,560 in cash, and we accounted for a 3% sales discount. Okay. And so this basically is sort of the introduction to receivables for us today. Just wanted to get us kick-started on our week.